So when you're looking at the recent volatility, it's showing the confusion on Wall Street and also Main Street. And that confusion is about what the hell the Fed is going to do over the next 6 to 12 months to ease inflation. This is something we've been highlighting for months on this podcast. Now everybody's talking about inflation. If you look at the markets, there's no denying it. Inflation is here, and it's ugly. It's very ugly. You can listen to every conference call. I mean, the companies reported so far, it's 15% of the S&P 500. Next 2 weeks, going to get crazy for earnings season. This is where I love the market. You listen to this conference calls, listen to what they're saying. They're all talking about inflation. They're talking about high commodity and material costs. How you need to raise prices to offset these costs. A lot of them, PPG is a good example. It's just one out of tons, almost every one of them. And I'm quoting here. They would continue to prioritize further selling price increases, which we expect will fully offset raw material cost inflation before the end of 2021. So prioritize further selling price increases. We're doing everything we can to raise prices for consumers. You can also see inflation in everything you purchase. Everything is much more expensive. Look at food, electricity, gasoline, streaming. Your streaming bill, cable bills, wireless bills, everyone is raising prices. Now, we have some experts going out there saying, hey, we don't have inflation at all. If we did, the 10-year yield would be increasing, not decreasing. You're crazy. Guys, this is one indicator. One indicator. Not the end all. I mean, you want proof of that? Go to any home and knock on their door. Then ask them, hey, are you paying more for everything you buy right now compared to 3 months ago, 6 months ago, a year ago? And when they say, hell yeah, absolutely, tell them, it's not true because the 10 years going lower, not higher. You're not paying high for anything. What are you talking about? Try telling someone, they're going to slam the door in your face or punch you in the face. Either one. But are you kidding me? People looking at the 10-year to judge inflation and saying, oh, it is transitory. It's telling us it's not going to happen later on. Are you crazy? You do not see this? Putting all your eggs in that one basket at a 10-year? I mean, the 10-year has little to do with 98% of businesses. It's not the rate they borrow at. If you're Microsoft or Apple, yeah, you can sell 17 billion, 20 billion in bonds to the markets, of course, which the government is buying. And those bonds could be 30, 40 years. They're going to, 2.5%, 3%. That's Microsoft and Apple, trillion-dollar companies. But if you're a smaller company with loads of debt, and now you're seeing cash flow falling along with earnings since margins are getting compressed as the price of raw materials and commodities, they're killing everyone. You don't have the pricing power to raise the price. Eventually, you're not going to have that. Right now, you do because the money, America and the world is just flooded with extra money right now. So they're going to pay whatever you want to pay for these prices. That's fine. But now they're seeing earnings come down, margins shrink. And they're not going to be able to borrow money at a favorable rate to grow. It's going to be much higher. So this means small companies that have loads of debt, speculative names, will get crushed if the inflation rate starts to surge. And you know what? Isn't that what's happening right now? Hey, look at the Russell. Look at cryptos. Look at the ESG names. Look at small caps in general. These are the speculative names. These are the names that people are pouring into. And again, bull markets, the speculative stocks go much higher than the ones with the better balance sheets. That's normal in every market. Just like if you're buying big, large caps and the market sells off, they're not going to sell off as much as these speculative names. But you saw the massive sell-off in these names. Some of these names down 30, 40%. Especially past 2 weeks, they got nailed, which is a clear sign the market's telling you, hey, inflation's here. It's here right now. And the markets, they don't believe it's transitory. Transitory. Man, I don't know how many times the Fed has used that word. It seems like a million times. I'll tell you why they're using that word in a minute. But guys, stop looking at the 10-year as an inflationary benchmark and look at what's really going on out there. I mean, home prices, all-time highs. Household wealth, all-time highs. Oil prices have surged. The S&P 500, even before Tuesday, Wednesday, coming back. Even on that pullback, still near all-time highs. And you put that in perspective on a 4% pullback. The S&P 500 was up 15% year-to-date. It was up 16% last year. It was up 29% in 2019. And everyone's bitching, complaining, running to the hills on a 4% pullback. Are you fucking kidding me? That's insane. So putting that move lower in perspective, it's not that bad as of now, but it could get worse because nobody knows what the Fed's next move is going to be. Is it going to tighten and finally admit inflation's not transitory? Or when we do see pullbacks like we saw with that 4%, people get nervous and maybe we'll go down to 7, 8, 9%. And that happens quick, right? We usually fall very, very, very quickly over the last 10, 15 years. Our market collapses happen within a few weeks and months and then gradually come back. That's it. It's not like the crash from the dot-com bubble. I mean, it was like from March 2000 to mid-2002. I mean, that's tough. That's a long just down, depressing. Doesn't happen like that. It happens really quick. These 20, even COVID, 20, 35% moves, boom, down. Then we gradually come up. And usually come up right away now. But what's the Fed going to do? They're going to, if the market falls, they're going to inject even more money into the system, which we all know this fact. Everyone in the world knows this fact is going to lead to much higher inflation. So where am I going with this? As an investor, here's what you need to know. The Fed is a political body. It's not separate from Washington like it was meant to be. It's a politically run institution. I don't care if you're a Democrat. I don't care if you're a Republican. Never, ever trust a politician. Don't trust politicians. I mean, I think we all learned that from the last 2 elections, no matter what side you're on. Don't trust your politician. They don't really give a shit about you. We all know that. But you have to treat the Fed like it's being run like the current party. I'm talking about with that current party's agenda. That goes for today with Biden in office, and that went for the last administration when Trump was in office. Again, I'm talking to you as an investor. I don't give a shit about your politics. Don't email me. I don't care. This is about making you money. That's why you're listening to this. Hear me out. So if you want to look to see how politically corrupt the Fed is, it used to have an unemployment rate target or a benchmark, which is established after the credit crisis, where once unemployment dropped to a certain level, they would start tightening, which means they're going to stop buying bonds and raise short-term rates. So you look a couple of years, right? Then the unemployment rate fell to under 6%. And that was in 2014, 2015. It was above 10% in 2008. That's where it went to, or right at 10%. They just hit just below 9.9, whatever it was. But it fell to about 5.6, 5.7, which is the historical unemployment rate dating back for 70 years. So, okay, it fell. And you said, okay, once it falls, then we're going to start tightening. But the Fed said, you know, we're not ready to take the foot off the gas yet. Because when we fell below 6%, and the Fed was supposed to start raising rates, and they didn't. So then what happened? The Fed said, whoa, wait a minute. Forget about that benchmark. Forget about the unemployment benchmark. There's still a lot of problems out there. We're going to focus on the inflation rate now. That's more important, right? So they changed their benchmark. The Fed said that inflation goes over 2%, that's when we'll start tightening, which is a great move because we stayed below 2% for what, 5 years? Up to early 2020 from 2014-15. So we stayed below that 2% mark, mostly. I mean, we went above it a couple of times, not really, but we stayed pretty much below it, which allowed the Fed to pedal to the metal. And we all know that early 2020, that was right before COVID. So it allowed the Fed to keep rates super low and continue buying tens of billions of bonds in the market, flooding the market with cash. Now let's fast forward to today. COVID has subsided in America. Everything's open. 6% of people vaccinated. More and more people are getting vaccinated because they're scaring everyone with Delta, which I think is hilarious. And this was after a $10.5 trillion injection, 45% of our GDP into the market, handing people checks directly, which never happened. I mean, it did happen, but not on that level. I mean, TARP was what, $475 billion to backstop the banks and save the global financial system. That's all it took to stabilize it. And some of those banks never lent that money out. They just wanted to make sure everything was stable. Banks are going to be fine. You're going to get paid. You can get your money out. And now it's fun. Now, $10.5 trillion? Are you kidding me? And this is leading to huge inflation, where the CPI, as of last month's reading, is up 5% now. 5%. That's year over year, 5% the CPI. And that gauge has been built in the Reagan era to never ever show inflation, ever. And that's showing inflation. So it's much, much higher than 5%. But we'll use their gauge, the government's gauge. It's 5%. 5% is much, much higher than the 2% benchmark it created. So now how does the Fed transition? Since it wants to continue to stimulate the economy. Again, it's a political organization. It benefits everybody. Stimulus, right? But inflation is well above their benchmark now. So what does the Fed do? It decided to change its benchmark again. What a fucking surprise. So it's not focused on the inflation rate anymore, since it's double the benchmark it's set where they told us it would stop easing. The Fed is now using the unemployment rate. Again, that's their benchmark, where it said, you know what, we're looking for unemployment to fall below pre-COVID levels before tightening. That number happens to be 3.9%. That's what it was in January 2020 pre-COVID, 3.9%. So the unemployment rate today is 5.9%. They needed to go to 3.9% before they start tightening. That's what they said. Now let's put that 3.9% number in perspective. That's the lowest unemployment rate America has seen since the 1950s. Since the 1950s. Now, why do you think the Fed has gone back to the unemployment rate as its benchmark? And specifically highlighted that it wants to see this rate fall below 4% again before tightening? It's because it's never, ever going to happen. Never. Our government continues to flood money into our economy. People are still getting paid more to stay at home than to work. And in many states that are not going to roll back this policy, they say they are. Oh, you know, you hear in the news those extended benefits are going to, they're not going to end, guys. They're not going to end. No way. No way. More and more people are going to have to go back to work, which they should be because they're getting incentives now. Even McDonald's is paying some tuition. People get $1,500 checks as sign-on bonuses to become, you know, waiters and bartenders. The greatest market right now to get a job. People just don't like to work. Believe me, I know that very clearly in Florida. So we're never going to fall back below that 4% rate, which is basically full employment. So the Fed, who's brilliant, they have to do everything they can to get people to ignore the rise in inflation, even from the bullshit gauge that they use. So what do? They put out a measured response telling the world that this huge spike in inflation is transitory. Again, we're going to say it a million times. It's transitory. We're not going to tell you how long transitory is. That word means brief. They're not going to tell you. But it's not going to be here long. It's all right. All those companies raising prices, they're going to lower prices soon. They're all going to say, you know what? I know all of our customers are paying this, but you know what? We're going to lower that now. We're going to lower the prices. That's what they're telling you, right? That's not what they think. They know that's not going to happen. We know it's not going to happen, but that's what they're telling everyone. And it's a measured response. We're hearing that word transitory every day, everywhere. You really notice how many times the Fed use every single time one of the Fed governors, they talk about transitory. For me, I want to know what transitory means. Is it 3 months, which that's transitory to me? Is it 6 months? Is it 12 to 18 months, which is a pretty big deal if you expect inflation to rise much higher from these levels over the next 12 to 18 months? I think that's something we need to know. But the Fed, no way, they're not going to say that. Now, when you put all this together, which is what you as an investor needs to understand with all this bullshit going on. That's why you listen to this podcast. I'm sure you're not going to hear this anywhere else other than people who are independent like us and own their own shops, because we don't have to have an agenda here. We just tell how it is. The Fed's not tightening anytime soon, guys. I mean, they made this crystal clear. And for those of you who think that's crazy, just use your common sense. And imagine if the Fed said that inflation is not transitory. So they can't say it's not transitory. Inflation is going high over the next 6 to 12 months, and every company is going to continue to raise prices. Imagine if the Fed said that, said it publicly. It would be forced to raise rates and stop buying bonds right now. But they're never going to do that. Why? Because we're heading into election year for midterm elections. It would crush the markets, crush consumers, and consumers always vote with their wallets. So the transitory policy is actually brilliant. I got to give them credit. I mean, it makes sense. It's great politics. It's going to be transitory. They know it's not going to be transitory, but as long as they say it's transitory, it doesn't matter how high it goes. Hey, it's going to be temporary. Don't worry. So what does this mean for you as an investor? Continue to buy every dip. The Fed's going to continue injecting money into the markets. Rates are going to be low through 2022, likely into 2023. They're not going to raise heading into midterm elections, which are, November next year? You think that's going to happen? You're crazy. And this is going to cause a further spike in inflation. But after midterm elections, look out. That's when the shit's going to hit the fan. The Fed's going to be forced to admit inflation's not transitory because they're not taking away any of these measures that stimulate the economy. which were stimulating the economy all along, and we had very good GDP growth before COVID. Now, you injected $10.5 trillion into the system. Earnings are higher than they ever been. Everything's at all-time highs, and you're still injecting money into the system. But that's when the shit's going to hit the fan. And you might see the markets really start pulling back earlier than that, maybe mid next year before those midterm elections. They're going to have to stop buying bonds. Going to have to raise rates aggressively. You see speculative assets probably fall 35% plus, and most names, even large caps, pull back 10 to 20% with defensive sectors. Banks do great when interest rates go higher. Gold's going to be a great. Defensive names, utilities. There's definitely going to be pockets where you go to where you can make money and outperform the markets. But that's where we're heading. It's pretty obvious. But for now, buy the reopen trade and be smart, because everybody puts these things in one basket. Don't buy the cruises. I mean, they probably have 35% of those boats in operation right now, and they're trading. I mean, they got to the levels where they're trading higher than pre-COVID levels. Are you kidding me? You got ahead of yourself there. Don't buy oil. Oil's tremendous. I mean, oil, you look at oil, I think oil's a great short here. Not necessarily the price, but a lot of these companies, I mean, Laredo Petroleum went up 10x over the past 12 months. Then they announced that they're cutting their workforce. Does that make sense to you? Your company's doing that good, and you're cutting your workforce. I mean, that sounds pretty crazy to me. You know, OPEC's gonna flood the market with oil, right? They don't want our shale industry to get to where it was before, when we don't need anybody anymore. And shale could produce at $60 across the board. Yes, you have some wells I visited, you could do 35. Most can't. And $40. But man, with oil at 70, these guys are going to produce like crazy. We're going to get back to those levels of 11 million barrels a day, which hit a record. But we really don't need OPEC. OPEC doesn't want that, so they'll flood. Oil's going to come down. But why are these guys laying off? Laredo, what do they do? A massive secondary from selling shareholders. Their margins are going lower. They report a bad quarter and the stock's coming. You're going to see that a lot in the oil industry. These things have come back tremendously. Not all of them, but man, these speculative names, holy cow, these insiders are starting to sell. How are you cutting costs in a market where oil is trading at what? 5-year highs, or whatever, how many year highs, and your stock's up 10x. It's just when you're cutting, it's a red flag. Why are you cutting costs for? So they're worried about margins right now. You're going to see that industry come down. It got well ahead of itself. There's a lot of headwinds out there. Less drilling from ESG. Yes, it could result in higher prices. You got electric vehicles. We're going to see the same demand that we saw. I mean, it bounced back very, very quickly. So you say buy reopen trade. I wouldn't go oil and cruises, but airlines. I mean, airlines are down to December lows where the FDA gave emergency approval for the vaccine. Holy cow. They're still 35% off of their highs, their pre-COVID highs. And not like the cruises, which are above those levels based on enterprise value, which assumes debt. Buy domestic hotels in the U.S. We're fully open. So you don't have to deal with bullshit with Tokyo closing the entire Olympics. Delta is going to spread like crazy. It's nuts. I went over statistics with you. I mean, you look at Europe opening up, population 4x out of Tokyo in some of these areas, or Tokyo has a population 4x bigger in some of these areas, especially UK and things like that. But, you know, they have like, what is it, 14 to 24, I think it's 24,000 cases that they're getting of COVID right now. And that's in the UK specifically. If you look at Tokyo, it's like 1,800 per day. Not deaths, just cases. And yet you're closing everything down. I mean, just say, hey, if you have the vaccine, you can go to the games. Delta, we know for a fact, it's 95% effective against the vaccine is 95% effective against Delta. But you close, I don't know what's going to happen internationally. It gets crazy in some areas, depending where you are. But I do know domestically in the U.S., everything's open, and we are definitely not going back. Definitely not going back. Unless there's a whole nother thing where the vaccines don't work at all. But people are done. People are done here. Everything's open. We're ready to go. Every state, even the ones that didn't want to open, were forced to open. So you know what? That's good for domestic hotels. And one of the names we have that's up a lot already, I think still pulled back about 15, 20% from its highs, we're up over 100%, is Red Rock Resorts. I mean, it's a good name. They own casinos and hotels off strip in Vegas. Huge growth, great quarters. I mean, be smart, but these things are going to reopen. People are going to be spending money like crazy. Growth names are also going to work, especially major tech companies. These names, look at Apple, Amazon, Facebook. I mean, they're starting to ramp higher, new highs. These are names that are going to go even higher over the next 12 months easily. But again, the Fed is making this crystal clear. It's not going to tighten this year or next. They're telling us that by saying transitory. Because they remove inflation off the table by saying transitory. Doesn't matter how high it goes. It can go 10%, 50%. It's transitory. That's what they're going to say. Because they need to keep the pedal to metal. And I can tell you, we're going to see times when the market does pull back like it did last week and on Monday. You see lots of volatility when inflation numbers like the CPI and PPI come out and consumer spending. And people can say, wow, inflation's really rampant. The Fed's going to come out and say, no, it's transitory. But we're going to see these type of volatile markets. But continue using these pullbacks as buying opportunities.